not only do the fixed income markets have the ability to influence a far greater universe of relevant actors, only fixed income markets can influence governments, only fixed income markets can influence private companies. If you even look into kind of which sectors are bond issuers, the statistic that I quote all the time, but I'm going to use now is, of the 100 biggest emitters of all time, who are collectively responsible for 75% of all emissions, only 30 are listed on the stock market, but will have debt outstanding.
Welcome to Asia Climate Finance, your front row seat to the policies, investments, and actors shaping climate business and finance across Asia Pacific. Subscribe now so others find this essential guide to Asia's climate economy, and note the disclaimers at the end. Now over to the host, analyst, investor, and author, Joseph Jacobelli.
Hello, good morning, good afternoon, or good evening, wherever you may be. Welcome to Asia Climate Finance. Today, we're joined by a truly brilliant guest who is changing the way we think about the price of climate change. Richardson leads the development of research at the Anthropocene Fixed Income Institute, and she heads a global team dedicated to supporting fixed income investors. Jo's journey is actually quite fascinating. She's a mathematician who spent a decade on the front lines of credit trading desks during some of the market's biggest crisis. You'll want to stick around for this one. We're diving into why the boring world of bonds actually holds more power over global emission than the stock market. We explore the high-stakes world of catastrophe bonds, instruments that are currently beating the S&P 500 while telling us exactly what the market thinks about our future. Jo also explains why she believes we're on the brink of financial regime shift, unlike anything we've seen before. We love to hear from you. If you have any questions or comments about today's discussion or ideas on topics, guests, etc., please do email the podcast via the address found at the top of the show notes. Now, let's get into the conversation. Hello, Jo. Thank you so much for joining the Asia Climate Finance podcast. I'm really, really glad that you were able to make it.
Thank you, Joseph. I'm looking forward to speaking about this topic.
Yeah, I'm actually quite excited about it, as we mentioned earlier, because, well, a whole bunch of reasons which I will re-emphasize later on. But first of all, let's talk a little bit about you, if we could, Jo. You've got a very fascinating journey in the financial markets, and could you start perhaps by telling us a little bit about your background and how you eventually found yourself at the intersection of the credit markets and climate finance?
No, absolutely. Thank you. And I think it's actually really interesting often to kind of learn people's journey to get to things, because of course it does influence how you think about things so much and really kind of change what you've done before and how you get there. So as mentioned, I work obviously in sustainability now, sustainable finance. I do a lot of research in that space. I know we're going to talk about it, but my story really started in traditional markets. Well, in truth, even before that, it started in academics, where I was, if you can believe it, a mathematician. And then I fell into traditional markets as a fresh-faced graduate, barely knowing really what I was doing. And I ended up on a credit trading desk as an intern. And I turned up on time every day and answered the phone very effectively. And that was really all that was asked of you then. And I ended up working in trading for about 12 years in market making. And in truth, that really gave me actually kind of a bug for the markets, right? Seeing them every day, seeing who's participating, seeing what different people kind of want, and how they can move and how they can respond to things. I actually wasn't an economics background. I was really very interested in kind of the markets and how they work. Right. So I did that at a large investment bank, accidentally, for a long time, which I loved. And of course, that was throughout a very interesting, not accidentally aging myself now, but through a very interesting period of the market, which was through the financial crisis and the credit crisis, and in many ways, the kind of European sovereign crisis. So really interesting. Then I actually took a sabbatical and explored the impact investing world. So that's not so much public markets, which I know we're going to talk about here, but more small, kind of private credit and even kind of private equity investments designed to help charities develop business models that perhaps don't rely on grant financing. So really interesting, really good understanding of like different the role between impact and financial returns and different financial models, which kind of started my learning, thinking about sustainability and investing and how these things come together. I actually went back into banking for another 5 years and actually did a slightly different job, a bit more mathematical and modelling. And then I moved into sustainability full-time about 4 years ago, which is when I joined the Anthropocene Fixed Income Institute and started doing the work that I know we're going to talk about today.
Wow, that's really fascinating. I mean, we have a very similar background. I was an equity analyst for many decades and had a couple of what I call real jobs, working for corporations, and now I'm an investor. But it's a fascinating journey that you've had. Now, I'm not sure that everybody may know about the Anthropocene Fixed Income Institute, AFII. So now your work at AFII is quite unique. And for those of us who are not that familiar with it, could you just tell us a little bit about the core mission and why specifically it focuses on fixed income market for climate action?
No, absolutely. So yes, I represent an organization called the Anthropocene Fixed Income Institute. I mean, again, the Anthropocene, which is, of course, the geological age in which we live, in which we believe that one can actually see in the rocks the impact that we're having on the environment. So I think that actually is quite a big image, and certainly one that I kind of quite enjoy in explaining what we do. So we are a philanthropically funded research organization. So we're entirely philanthropically funded. And our core audience is, well, investors in public fixed income markets. And I think quite an interesting part that maybe we'll get to later. There's lots of really interesting thinking in this area, but not much of it is kind of focused on what one might say is kind of like the boring bits of the investment grade bond market. And actually, This is where money is moving hands, and this is what is responsible for financing a lot of the core sectors and industries that need to transition. So our mission is to strengthen the relationship between cost of capital and climate and nature loss risks. So what do I mean by that? If we can work with investors and support them in integrating these risks and opportunities in their investment decisions, that will differentiate the cost of capital, and that can drive behavior change. Let's assume I'm the CFO of Total and I'm trying to decide how to allocate capital and what projects to invest in. If I am delivered a different cost of capital for those projects, depending on the overall climate risk, perhaps of those investments, that will impact me. And that is a lever that can change my behavior. As part of lots of the other levers and policy and engagement, lots of things, ultimately, companies, governments are extremely sensitive to their cost of capital. And I think, why are we so focused on public fixed income markets, aside from the fact that we're not sure, we think, look, perhaps it doesn't get as much attention as it deserves. Not only do the fixed income markets have the ability to influence a far greater universe of relevant actors. Only fixed income markets can influence governments. Only fixed income markets can influence private companies. If you even look into kind of which sectors are bond issuers, the statistic that I quote all the time, but I'm going to use now, is of the 100 biggest emitters of all time, who are collectively responsible for 75% of all emissions, only 30 are listed on the stock market, but they will have debt outstanding. Now, that's because they're governments, because they're NOCs, because they're privately owned entities, but they are all dependent on fixed income markets. So you have the ability, at least in theory, to influence a much broader range of relevant actors for the transition. But then also, secondly, and we do a kind of bit of work specifically here as well, fixed income investors have lots of different levers that they have for influence. I mean, lots of people are familiar with, I'm a shareholder, I own a little bit of the company, I can go to the AGM, I can vote, I can raise a resolution. But actually, in the fixed income market, because of the refinancing nature of the instrument, so again, the US corporate debt market turns over entirely on average every 5 years. Companies, borrowers are constantly coming back to market and asking for money again. At that point, investors have tremendous influence. I need to see movements here. And actually, if you're going to continue along this transition path, the price I will lend you money is different. So it's a very different dialogue between fixed income investors that are constantly refinancing and equities. So we think fixed income investors have tremendous influence.
Also, when it comes to impact investment in general, globally, I mean, if we're talking about where does the money come from? I mean, obviously, you've got money from philanthropies, multilateral, some commercial bank lending, etc. But the fixed income market is huge. And I think if you look, for example, at the climate bond initiatives, what they've done with the green bonds, and those numbers just keep on going up and up and up and up. So I think it's very important. So maybe we can focus down on something very specifically, because you recently published a really interesting report titled "What the Catastrophe Bond Market Could Be Telling Us About Climate Risk." And in the report, you have a deep dive into catastrophe bonds, or what we call cat bonds. To get everyone up to speed, maybe we can have a few one-on-one questions for those not that familiar, including myself. So in the simplest terms, how do these bonds actually work?
I mean, it is a great question. And in many ways, key kind of objective of this piece of work is just everyone sort of talks about it. Everyone sort of thinks it's an interesting name, but it's quite niche and it can be quite complex. And we are just trying to get more people up to speed with this product. So firstly, a cat bond is a bond, right? Which means there's an investor who gives some money up front and receives a coupon along the length of the bond, and they take some risk, and then they receive their money back if the thing they've taken risk to doesn't happen. So a regular bond, I lend someone some money, the risk is that company going to default and pay my money back or not, and I get my coupon. Here, rather than a borrower, and this is maybe the first complex bit, the fund, and I'm talking about the usual structure, of course there's different transactions, the funds are usually kept in a special purpose vehicle. So again, that makes them a bit complex. And these special purpose vehicles, or SPV, are often in like some Caribbean jurisdictions because these things are offshore, which again makes them complex. So I'm an investor, I give my money to a special purpose vehicle, which kind of looks after it. And then there's an extra kind of party to the transactions, which is usually called the deal sponsor. That's the entity who's often an insurance company or a reinsurance company, and they're providing the coupon. So they're saying, I'm going to pay you this coupon, a bit like a premium, and then if the event that we're having insurance against, the peril happens, then I will get some of the money that the investor put in to kind of make me whole. So it's very similar to a bond for an investor. I get a coupon, and if the bad thing happens, I lose some of my money. But they're structured a bit differently because you have this kind of insurance company or a deal sponsor who may be kind of having the insurance premium type transaction, which is referenced by the deal.
Right. So what is the primary draw for an investor, and why would they want to have cat bonds in their portfolios?
Yes, I mean, and in many ways, like that was one of the core kind of things that we found that was really interesting about the market, which we're now kind of trying to talk to people about, because certainly at the moment, my opinion would be that it's quite niche. Not that many people understand them. The bonds are in designated cat bond kind of funds, and it's only if an investor kind of knows about that would they think about that. I mean, so maybe let's even take a small step back. Like, what are fixed income investors typically trying to do with their portfolio? It is maybe a different style of investing to an equity. There is very limited upside.
Yes.
I'm really trying to make sure I sort of do get my money back, and I receive some kind of yield target depending on my liabilities or depending on if I'm a pension fund or an insurance company, etc. So actually, it is a very different payout expectation in fixed income, lower risk and a kind of steady rate of return. And in that sense, one of the pieces of work we did in this report actually was to compare the recent performance of cat bonds with some other examples. Oh, how did the high yield market do, or the high grade market, or emerging market bonds, like for a comparison to maybe try and think about why investors might choose this product over others. And actually, one thing that we found, and I'm sure we can talk a bit later about why I think this is the case, was what a standout return this product has been actually over the last, well, I think we went back even as far as 10 years, but over 5 years, the average annual return is 10%. So that comparing that to 14% for the S&P, i.e. the stock market, which has had a stellar 5 years, right? And versus a standard deviation, which is half. So often we look at this kind of Sharpe ratio, which is the ratio between the average return and the standard deviation. Cat bonds, on a risk-adjusted basis, have really been the standout.
Yeah, and obviously if you're investing in the stock market, the volatility, especially recently, has been absolutely astronomical. And I can testify that I have had several heart attacks in the past 12 months. But anyway, that's a different conversation. Now, in this, as you called it, in this niche world, are there specialist cat bond traders and dedicated fixed income desk handling these, or how does it really work?
Yeah, no, and a great question. And I think, again, I'm not necessarily sure I even have all the answers to this. I've done a bit of work, and I certainly share what I found. And in many ways, the less you find, the more it suggests it is quite a niche kind of product.
Right.
I mean, certainly, we did a bit of work as well into who held these bonds and what we could see from the funds. And I would say it seemed to me that the majority of the funds who held these bonds were dedicated to the product. So either cat bonds, or another phrase you might hear related to this is ILS, which stands for insurance-linked securities, which is another word used to describe them. So lots of the funds had those names, or specifically focused on this product. And again, from an investor point of view, they often offer some very decorrelated returns. So you might say, well, I'll allocate 10% of my investment to this cat bond fund, and that kind of sits well alongside. So I think the structures are quite niche. They do have this usual offshore kind of special purpose vehicle structuring. My understanding would be that it is specialized teams who look at them.
Understood. Final question on, let's call them the 101 kind of questions, if we could. How large is this cat bond market today, in terms of total issuance? And are there any kind of growth projections over the coming years?
Yeah, and again, maybe another quick kind of shout out. I got a lot of information in the report from this website or data provider called Artemis.bm, which is great. They provide a kind of snapshot market and snapshot report, and they have some volumes, which is where we got some of this data from.
We'll put that in the show notes as well so that people can have a look at it. Yeah.
So in 2025, total issuance was reported to be just over $25 billion, higher than 2024, where the total was 18. So that's quite a big increase actually year on year. However, one other thing to realize about these securities, another reason why in fact they can often offer some diversification and decorrelated returns, is they're typically very short maturities, usually 4 to 7 years. So fixed income maturities are often very long dated, or they have maybe longer duration is kind of what's called. So here, because they're quite short dated, that means they roll off quite quickly. So in fact, the total outstanding notional we calculated as just over $62 billion. Now, how do you go about thinking, is that a big number? Is that not a big number? Not really kind of sure. I mean, I think it sounds like quite a small number if you compare, for example, numbers floating around. I've got here the estimated global natural peril economic cost in 2024 was $417 billion. So it's certainly multiples less than that. And obviously, these are still insurance products. You're never going to expect them all to pay out, right? The volume of insurance, one would expect to be many multiples of the volume of actual losses. So it still seems kind of small. However, there certainly are a few interesting things we're seeing, which I know we're going to go into later. In terms of future growth, I saw one prediction, which is kind of roughly flat. I don't think people are predicting continued exponential growth of this product necessarily, but I think that depends very much on how we see losses unfolding. It is we're in my view, kind of quite an uncertain period of time for physical losses, and that losses coming from extreme climate events. They're rising, they're gaining in kind of concern, and people are very concerned about these issues. And this is one of the products that I think people will go to if they want to get some extra protection from those.
Yeah, and I mean, whether you're talking about climate change or not talking about climate change, extreme weather events have been increasing. Whether whether you're a climate change denier or not. So obviously, I mean, I personally think it's gonna grow quite a bit, but this is my own personal opinion. Now, moving on to some of the things in the report and some things kind of related to the report. You mentioned that cat bonds tell us what the market actually thinks about climate risk. What is the market currently saying about the frequency and severity of these climate disasters compared to a few years ago, say 5 or 10 years ago?
And look, even a little more maybe kind of intro to this, and this maybe goes back to both of our backgrounds, like almost this is kind of an idea which maybe people are more comfortable with in, say, option pricing theory. Yep. We're saying what is the market is never wrong. The market is telling you the fair price between buyers and sellers and the expectation of things. It's obviously in the kind of option land, you might call this like the risk neutral volatility. So we've got historical volatility, we've got the realized volatility, and we've got market implied volatility, which is where people can actually transact, and the fair price that will then, through the models, imply what's going to happen. So 2 parts of our analysis certainly suggest that the market, the cat bond market, is pricing the risk of these losses potentially significantly higher than historical realized. Firstly, we were able to look at the coupons of these bonds. So again, they tend to be quite short dated. They often tend to have floating rate coupons, but you can go and then look at what the first coupon was, which is perhaps a measure of the price that the bond was actually issued at. And the first coupon of the bonds has been moving quite a lot higher in the last 5 years compared to earlier. So in our data, the average was just below 4% in 2021, and this is just of all the bonds issued, and it rose as high as nearly 12% in 2024.
Wow.
Now, that is alongside a change in risk-free rates, of course, right? That is just one data point, but that's quite a big movement higher. And as we would all sort of say in a market sense, if the price is moving higher, that kind of means there's more buyers than sellers. And here that's more buyers of protection in the cat bond market than sellers of protection in the cat bond market. So that would potentially suggest a supply-demand point for me. And the price that these deal sponsors are willing to pay for their protection. The second part goes back to this point that we talked about already about the performance of these securities. So over the last 5 years, the performance of these securities has been very attractive. i.e. investors are being well paid compared to the realized losses that they're experiencing, right? These attractive and consistent risk-adjusted returns can also be interpreted as excess spread in the system. i.e. there is a risk premium because people want to pay for protection and realized losses have not yet risen. So those are the two things we observed. I would interpret that as being lots of demand for protection and potentially also an indication that losses could rise in the future. I mean, I guess no one knows what's going to happen, but certainly the market implied expected loss is higher than we're experiencing at the moment.
Right. We've talked a little bit about insurance, insurance companies, etc. The traditional insurance models rely very heavily on historical data. Why do you believe that these kind of backward-looking models are now not failing or not appropriately accounting for our current climate reality?
And this certainly now goes into kind of what my view is and what our views are. And you sort of mentioned climate change denier. I'm not a climate change denier. I think we are in the midst of unprecedented changes to our climate. And almost this is, again, the fundamental representation of the past is not an indicator of the future. So,
yes.
But that's my belief. I believe more and more we're going to see, unfortunately, some of these tipping points, and it's going to be very unpredictable. So, however, even now kind of back to the cat bond market, though, I think it's a really interesting question of what the role these models have, because lots of insurance premium, insurance risk management is underpinned by historical models.
Right.
And from my understanding, the insurance sector does use models, and there are a few different ones, but each of which is ultimately based on a historical assessment of loss. And as we said, all market participants will tell you the history is not an indicator, but it also highlights, again, from this kind of option pricing world, if the price is telling you something and you try and put it into a model and it doesn't really work, what does that say about your models? But what we hear on how these transactions are actually priced is the kind of price of the bond is almost a multiple of the model. So you might say, I'm going to price this bond at 2x the risk model or 3x the Moody's model. And it's actually how we're seeing those multiples change. There is an understanding that the model is an indicator and the price is not necessarily related to the model. The models are more used to, say, compare between two different structures. How is the different risk in this region versus this region? So I don't know. Again, if we get to a phrase in cat bonds land where perhaps investors start losing lots of money because there really is evidence that the models are not working, that could also be a really interesting trigger for people to revisit the models more quickly.
Got it. Moving on to something, putting a little bit of color, because we talked a lot on kind of high level so far, but talking about some real life examples. For example, just take, I don't know, one extreme event, a weather event, wildfires, or event caused by extreme weather events. So how do you see wildfires as a risk, for example?
Yes, and another really kind of interesting thing we observed from looking through the cat bonds was, well, again, anecdotally, if one looks at the kind of perils that are covered traditionally by the market, lots of them are very vague and lots are very general. Lots of them use things like multi-peril. What does that mean? Lots of them are entire regions, earthquakes in Asia or storms or these sorts of things. But what was interesting was there was this real uptick that was observed in Q3 of last year, where suddenly California wildfires, quite narrow in terms of peril and quite narrow in terms of region, I think featured in nearly a quarter of the deals in that quarter. So, and obviously, unfortunately, there were terrible wildfires in Los Angeles at the start of the year. Lots of insurance companies realized how exposed they were in a very correlated sense. And they went to the market to try and get some protection. I mean, I also kind of view that as a potential example of kind of what we talked about earlier, which is the opportunity for this market to offer diversification. As events happen, as insurance companies, reinsurance companies, investors realize how exposed they are going to seek a product which gives them the ability to diversify risk. And I think seeing such a narrow peril feature in so many transactions shows that there can be that response.
I mean, what's interesting about the California wildfires is that it was very high profile, particularly because there was this kind of luxury area where, maybe 20 years ago, was it called Pacific Palisades? Yeah, Pacific Palisades, something like that. Neither of us are American, so but yeah, I mean, it was very, very, very high profile because my understanding is that the whole area got completely wiped out and doesn't exist anymore. And rebuilding is going to be an issue because if you rebuild, you can't get insurance. So it becomes quite interesting. Now, insurance losses are rising, right? So, but cat bond issuance seems to be relatively low in comparisons to this insurance losses rising. Why is there such a massive gap between the physical damage we see and the financial protection available?
Yeah, and I mean, I guess I'd make one point even before we start on that question, which is insurance companies' business is to take premiums and suffer some losses, but hopefully not too many losses, right? Like insurance companies, if they pay away protection for all their insurance, are not an insurance company, are not going to make any money. They have to balance the premiums they're getting in, their investment returns, and manageable losses in a kind of quote unquote controlled way. And I think what the cat bond market tells us, or even what some of these events tell us, and I'm in fact going to hark back a bit to my earlier days where, if you can believe it, I was very active in like structured credit and tranches in the kind of mortgage crisis. These are the highly correlated events that insurance companies want to offer insurance on loads and loads of decorrelated events so that only a few of them happen and they're getting premiums on all of them. Whereas if suddenly you've got an event that is so severe and so correlated in terms of your losses that it's almost like the super senior tail event in tranche land of what you're talking about, that is, of course, when you may need to go out and seek additional protection. I think that's the insurance gap we're talking about here potentially. But so it's only ever going to be that kind of tail amount. But then I think what's also really interesting about the scenario you just mentioned with the LA wildfires and potentially the rebuilding is one of our views as well, and a potential positive that can be incited by some of these products is, can you use them to incentivize the right sorts of adaptation and resiliency spending? So let's now say you own one of those extremely high value properties in LA and you now need to rebuild it and you're concerned about insurability or lack of insurability. One would hope there can be a conversation on the lines of, if you rebuild your property using these extra resilient fire protection metrics and leave fire gaps and do all of this resiliency investment in your product, your insurance premium will be X. And if you don't, then your insurance premium will be either impossible to get or significantly higher. Right. And that's obviously a very small scale example of how insurance premiums and even the cat bond market, which is kind of showing you the price for the tail risk of these markets, can incentivize risk-lowering investments in adaptation resiliency.
So we often think of these as tools for insurers, right? But how can sovereigns or, large corporate entities or others use these instruments to manage their own physical climate risks?
Yes, and there's certainly happened a couple of really interesting case studies on the sovereign side. So as mentioned, we talked about the kind of standard structure, which is for the deal sponsor to be perhaps a reinsurance company or an insurance company who uses this to offload their risk. But in fact, there have been some sovereigns who've used them to also fund and get tail protection themselves. The World Bank, in fact, has a really interesting program where it uses this market to fund its disaster protection. They call it the Capital at Risk program. It's reported so far to have issued just under $5 billion of cat bonds. And this program was also behind something that got quite a lot of press at the time, which was the Jamaica issuance. So Jamaica had bought disaster protection via the cat bond market, via a World Bank issued bond twice. And then, unfortunately, it was hit by Hurricane Melissa at the tail end of last year, and one of the cat bonds paid out. And I think what got a lot of good news stories there, it wasn't even so much that Jamaica had bought protection and therefore used this to diversify its risk and insure itself. It was actually that because of perhaps the private sector nature of that transaction, it received its money very quickly. And it received its money really still while it was in the throes of cleaning up and supporting its people after that terrible disaster. And that also provides a lot of support to the government when such a thing hits.
Yeah, and kind of people tend to forget that when a whole area gets completely wiped out, be it by a storm or a wildfire, I mean, we're talking about some very, very major reconstruction here. The cat bond market has largely been so far North America. I mean, not just North America, but a lot of it has been in North America. Turning to Asia, we see massive climate exposure in the Asia region, but a relatively young cat bond market, right? So, if you were to kind of look at through your glass bowl of forecasting, what is the scope for growth in Asia, do you think?
I mean, exactly as you say, there aren't that many transactions necessarily, though I'd love to share a few examples, which does mean the growth must be there's quite a lot of potential for growth there because it really hasn't developed the products as much as, say, others. And I think, as you say, there are lots of the same factors at play that would make it a suitable product. So certainly at the moment, the majority of these insurance company issued structures tend to be listed in Caribbean islands and tend to have their insurance company or deal sponsor be North America. But it's worth pointing out a decent number of them, Japan have earthquakes, right? And especially in light of, for example, obviously the tsunami from maybe 15 years ago has been a feature and has always featured as one of the perils as covered, even if it's perhaps a US insurance company who's seeking protection from that. There have been Asia perils as listed. I mean, the sovereign transaction that I just mentioned as well, where we saw Jamaica use the structure in order to protect itself from hurricanes. We have also seen similar transactions done by the Philippines. The Philippines issued one of these bonds in 2019, also buying protection against tropical cyclones. And in fact, a payment was made under one of those bonds in 2022 after Typhoon Rai. So we have seen sovereigns in the region do that as well. And I think that whole World Bank program targets a number of different regions, and one would think that would be quite suitable for ongoing use amongst Asian governments.
Right, especially because there's so many countries in Asia that are prone to flooding, and it's pretty scary. How is the cost of insurance actually translating into the development of or growth of transition investment, especially for adaptation and resilience?
I mean, this is probably still me hypothetically telling you how I think it should be and what I think should be the dream of these things. But as we say, investments in adaptation and resiliency reduce risks. Right. And insurance companies and insurance premia are in the market of pricing risk. And it's not just, say, areas where they now can't be insured. And of course, insurance companies commercially want to offer as much economically rational insurance as they can, but also it's a competitive market. So if you do things that lower your risk, insurance companies should rationally offer you lower premium for that. Right. So I think this is a really powerful route to transmitting the financial benefits of adaptation and resiliency. So I think in terms of transition investments, to the extent that transition investments can be directly linked to lower insurance premium, this is a really powerful route to incentivize those.
That's great. Joe, second last question, and it's about your outlook. I mean, you've been, although you're still extremely young, you've been around the block a couple of times, so you've seen a couple of market twists and turns. If you were to tell somebody, how would you see the future over the next 3 to 5 years, and also maybe over the next 20 to 30 years? How do you see the relationships between fixed income and climate risk evolving? Will we see climate risk become a standard metric as credit risk?
I mean, I think I'm probably older than you think, but I will take the question anyway. Bigger picture, my answer definitely has to be yes, right? I, as said before, unfortunately, do passionately believe that we're on the brink of a regime shift that we unfortunately have not seen the like of before. More specifically, of course, I wonder if the question is really whether climate risk is a standalone factor or, of course, it integrates into so many existing risks. But what I find interesting about your question in particular, and I want to also answer that through the lens of being some kind of geeky bond person, is actually another lens through which fixed income markets are so important is that of duration. And either 3 to 5, it's one of the few places where you have a 20 to 30 year outlook, because if you're lending 30-year money to some company via a fixed income instrument, you are locked into that period of time. And you can really see the time horizon of these things quite differently. So for me, fundamentally, transition risk and business feasibility risk, profitability will feature much more heavily in general credit risk going forward. I mean, it has to. And actually, it's through those long-dated bond curves. We've done quite a bit of pricing work, for example, on long-dated oil and gas bond curves. Are they pricing stranded asset risk correctly? Are they pricing transition risk correctly? In the short term, we might have a clearer handle on what can happen in 3 or 5 years. But 30 years is a long time, and there is tremendous uncertainty, in my view.
No, that's absolutely excellent, and I couldn't agree with you more. But let's not have a conversation where two people actually agree with each other. Otherwise, it's too positive. But so on a completely different note, we started this feature with the last episode. If you don't mind, Joe, a recommendation that you have for listeners. It can be a book, it can be a report, it can be a movie, it can be a documentary, whatever is something that you would like to recommend.
I would love to, and I confess I've got 2, if that's okay.
Sure, of course.
Firstly, and this may not be popular, but when I first moved into sustainability about 4 years ago, I read The Prize. Now, The Prize is an 850-page Pulitzer Prize-winning history on the oil and gas industry. And I'm embarrassed to say I lugged a hard copy of it around for months while I was reading it. So this begins in 1859 in Pennsylvania, where they discovered oil. Now, actually, for me, this was really important reading. I think you do have to think about the broader context of how we got to where we are, right? And it's very easy within the sustainability community to be extremely dismissive of the role that fossil fuels have played in history, right? And maybe this is a kind of know thy enemy approach to transition. But I knew nothing about the oil and gas sector, and this is a riveting read to the extent that a 900-page book can be considered as that. Secondly, I also believe very much in the need, when I'm going to move slightly to nature, I feel very much in the need that individuals need to connect with nature. If we don't experience and enjoy and appreciate local nature every day from a young age, why would we fight to protect it? And I do think on an individual basis, we all should connect with what we love and enjoy the most. I rave about, Sir David Attenborough has just released a documentary on wild London, showcasing some lovely ecosystems that exist around us every day. It's fantastic. And I'm actually fortunate enough to live right next to Epping Forest, which is an ancient woodland in northeast London. And there is a super podcast on its ancient trees, which is called Treeamble. And I certainly find these sides very interesting. For me, you do need to know what you're fighting for.
That's fantastic recommendations. And of course, a third recommendation, which I'll make on your behalf, is your report, what the catastrophe bond market could be telling us about climate risk. Joe, this was a fantastic conversation. Thank you so much for taking us through first the 101 and then real life examples and some thoughts about the future. Really appreciate your participation in Asia Climate Finance.
Thank you so much.
Please note that the Asia Climate Finance podcast is provided for educational purposes only and does not constitute investment advice. Any information discussed should not be relied upon for making investment decisions. Listeners should always seek advice from a suitably qualified and authorized investment professional. The views and opinions expressed by guests are their own and do not necessarily reflect the views of their current or former employers or of the podcast host or producers.